Ladies and gentlemen, good day and welcome to the Ola Electric Q1 FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Chauhan from Ola Electric. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, we are pleased to welcome you all to Ola Electric's first earnings call, where we discuss its financial results for the quarter 1 of the financial year 2025. From Ola's management, today we have Mr. Bhavish Aggarwal, the founder, chairman, and managing director, along with Mr. Harish Abichandani, the chief financial officer. I now hand over the conference to Mr. Bhavish Aggarwal. Thank you, and over to you.
All right. Hello, everybody. This is our first earnings call as a public company, so we're all very excited about sharing updates with all of you. And I'm just looking at the names. Looks like some people that I also know. So good to see all of you. We've released a press release. We put up the statutory financials, and we've also put out a presentation on our website. So I will just walk you through some thematic updates, and then happy to do a Q&A at the end of it. So if you see some key metrics for this quarter, overall this quarter has actually been an important quarter in terms of both growth as well as profitability, as well as some key initiatives that have continued to mature well. Key metrics, if you look at our total income, we had 1,718 crores in this quarter. It's the highest ever, year-on-year about 34% growth. We had a good number of deliveries, 1.25 lakh through the quarter, a 77% growth over last year. Adjusted gross margins were about 21.94%, again about 873 bits higher year over year. This quarter also, we had a very good market share performance. Almost 1 in 2 electric two-wheelers sold in India was an Ola vehicle. 48.6%, and our EBITDA margin also, consolidated EBITDA margin, went up to negative 7.6%, about a 660 bps improvement. Now this quarter onwards, and this is the first quarter results that we are publishing. We have also started showing a segment view of our business. There are 2 segments. Obviously, we show the consolidated view. We continue to show that, but we have the automotive segment and the sales segment. And we in our discussions with many of you analysts through the process, we realized that people wanted to understand the 2 types of businesses separately. So we decided to share more information with all of you so that you can see the health of each individual business. And I'm actually very happy to share with you the numbers on the automotive segment. If you see the financials, we have made significant EBITDA improvements there, segment EBITDA. Our segment EBITDA is now negative 2%, which is just on the cusp of a positive point. And this has improved, I think, quarter on quarter about 7 percentage points. Some key operating highlights. Firstly, on growth. Like I mentioned, we have a strong market share in this quarter, 49%. Market share numbers will move up and down through the next few quarters as the industry evolves. But another good sign is our overall volumes continue to grow, our highest ever volumes. And a very important point that I want to share with all of you is while the volumes have grown, we have also grown both the category of products, the premium products and the mass market products. Mass market is roughly what you would think of as sub 1 lakh rupee products. And in our data, we have the data numbers of premium deliveries as well as mass market deliveries. So you'll see the split of that. And you'll see that while our mass market scooters have grown, our premium has also continued to remain steady and actually slightly inch forward. So that's a sign of a deepening penetration in the market. Our mass market products are reaching out to parts of the country, up-country markets, etc., where probably the premium products were slightly costlier for the consumers. It also, like I said, shows a growing industry penetration. If you look at July, which is the latest month, right after this quarter, the numbers are published through the Vahan portal. The e-two-wheeler industry penetration grew to about 7.4% in July. This is across all categories of two-wheelers. And within scooters, the penetration has gone up to 21% in July. So almost higher than 1.5 scooters sold in the country now is electric. And actually there are 9 key states which include big states like Maharashtra, Karnataka and UP, where the scooter electric penetration is now upwards of 30%, which is a very important milestone. 1 in 3 vehicles almost is a electric scooter there. And like I mentioned, with our mass market portfolio, we are seeing an early uptick in upcountry tier 3, tier 4 markets also. On the theme of growth, one important point I want to highlight to everybody on this call is that we are launching our motorcycle portfolio tomorrow. Tomorrow is our annual product launch event, 15th August, India's Independence Day. But I would like to share some highlights with all of you today, and remaining will have to see the event tomorrow. But we are launching a portfolio of motorbikes across premium and mass market categories, and these will be available for delivery soon enough within this financial year. So remaining details you will see tomorrow. But this week we believe the next big frontier for EV penetration and EV growth in India is going to be the motorbikes. As many of you would know, motorbikes account for about 2/3 of the Indian two-wheeler market. So it's a very important step that this company is undertaking, and we have a bunch of announcements in more detail lined up for this tomorrow. Now moving on from the theme of growth into profitability, there are 2 highlights here I would like to give you. The adjusted gross margins of the company have improved both quarter-on-quarter and year-on-year. And this is, by the way, despite a reduction in FAME subsidy in this quarter since actually through the last year. Our gross margins have improved because primarily our Gen 2 platform, which we had announced in August last year, and then through the last 6-8 months, it has ramped up production, with the latest being the S1X products, which came into deliveries only in this quarter, Q1 of FY25. So with the Gen 2, we've been able to reduce our BOM costs, and as a result, you see the improvements in adjusted gross margins. In addition to that, we've also seen an improvement in overall EBITDA margins, almost 670 basis points. And specifically within that, the automotive segment, which is primarily a large part of this company right now, is almost EBITDA break-even. And we've done this by we've reduced some part of our direct and indirect cost structure beyond the vehicle BOM. And we've also used some technology around AI and digitization to reduce our distribution costs. Moving ahead into some key operating highlights, specifically around the cell, which has been one of the areas of interest for many of you. I'm happy to announce and share that the phase 1A of the Gigafactory was completed by the end of March 2024. And that was 1.4 gigawatt-hour, and now we are producing cells. We've produced more than 30,000 cells since then already, and ramping up month by month. These cells will get integrated into our products by Q1 of FY26, and that is an important milestone because that will help both profitability as well as getting critical mass for our cell Gigafactory to further then in the future expand into adjacencies like energy storage, etc. Another important milestone that we crossed in this quarter for our cell segment was that we received the BIS certification in May. Now, BIS certification is an important milestone in getting the cell production ready and certifying all the key specifications of the cell. You also see in the presentation, if you guys have that, a very nice visual of our cell and some key specs. The fact that it is 5x energy than a 2170 format cell, which we use right now, and most companies use that in their vehicles. We get longer range in this cell vis-a-vis the current 2170 cells. And this IP has been built by this company through its R&D efforts. More than 70 patents have been filed in the engineering and production of this cell. Now, those are some operating highlights. Just to summarize it for all of you, important progress on growth with the best market share, highest volumes, highest revenue, improvements year on year, as well as a very important progress this quarter on profitability due to our Gen 2 platform coming to maturity, S1X launching, that's leading to penetration, and both adjusted gross margins and EBITDA margins reaching to improved levels, and specifically automotive segment EBITDA margins getting to almost breakeven. So with that, I think I will end my remarks. There are in the presentation some financials, consolidated and automotive, which I am not covering, which I will leave for you guys to look at. Now, Harish and I are happy to answer any questions you have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. The first question is from the line of Chandramouli Muthiah from Goldman Sachs. Please go ahead. Chandramouli, the line for you has been unmuted. You may proceed with your question. As there's no response from the current participant, we will move to the next question, which will be from the line of Gunjan from Bank of America. Please go ahead.
Yeah, hi. Thanks, team, for taking my questions, and congratulations on the listing. I also you should mention that it's good to have the segmental reporting. This is something that was very much on top of our mind, because otherwise we can't assess the difference between the auto and the battery business profitability. So it's nice to have that, and I hope that continues through. Now, two questions. Firstly, on the margin side, could you also help us understand how does the gross margin profile stand when the subsidies, X of subsidies, both PLI as well as EMPS?
Sure, Gunjan. Good to have you here, Gunjan, and we will definitely, our goal with providing these segmented financials is so that all of you can understand the business in more granularity. And as you can see, the automotive business is actually obviously in a decent shape. Now, on the margin, if you think of the two subsidies, one is FAME and one is auto PLI. We don't yet approve anything from the cell PLI, which is the other PLI we are part of. The FAME subsidy is about 10,000 rupees a vehicle, maybe 1,000 rupees here and there for this quarter, given that this quarter was the changeover from FAME to EMPS, and there was some old backlog, maybe 11,000 or so. That's where it would be. So that would be about 8 to 10 points of margin there, right? And then PLI, we are recognizing right now for our S1 Pro and Air, not S1X. So what we recognize there, whichever product gets it, I think Harish recognized about 13% of it. So you will assume maybe on 50-55% of revenue, you'll get 13%.
Okay. So fair to assume that, roughly around 14%, so 8%, maybe 8 to 10% on the EMPS, and another 6-7% on the PLI would have accrued in this quarter?
Yes.
Okay.
Yeah, I think actually those are reasons.
Okay, got it. And from here on, if I just think about the margin trajectory, what are the other cost levers, from the next 12 to 18 months perspective, what can really kick in terms of either cost savings or particularly at a time you will also have the bikes kicking in, right? So how do we think about the roadmap of the margins with new product kicking in, and anything that you can share in terms of cost improvements yet to kick in?
Sure. On the bike specifically, Gunjan, the bike is built on the same platform as the scooter, which is the Gen 2 platform. So all the key aggregates like electronics and motor and the cell manufacturing processes, etc., all are same. So the supply chains are all the same. Hence, the bike starting point will be where the scooter current point is. Right. So even on the manufacturing side, there is no real incremental capex installation unless we have to increase capacity, where we are at about 1 million units installed capacity right now. There will be some small capex here and there, but the major capex will be only for capacity increase because the same, largely the same platform. So the bike will start from a similar cost structure on the BOM cost. The pricing we will see tomorrow, so that is the other part of the gross margin equation. On the roadmap of gross margin improvements, there are 2 or 3 important themes here which I want to highlight. Firstly, the big mover on gross margin will be the cell, which will be, like I said, Q1 of FY26, which is about, let's say, 9 months away, 8-9 months away. That's when a big change in the gross margins will happen, because that's the next big piece of our vertical integration strategy. Till then, there are a few other incremental things on BOM costs which are reducing through a mix of negotiations with suppliers, different supplier mix, co-location of suppliers into our EV park, which reduces the cost of supply to us, etc., etc. So through a lot of these activities, the cost keeps coming down incrementally from here to there. And then at that point, there's a big change which happens with our own set.
Okay, got it. Just last question on the battery side. 1,300 is total money that you've invested. How should sorry, I'm not sure if my voice is echoing, but maybe I'll just repeat the question. On the battery investment, if you can just call out, how do we see the investment panning out? 1,300 done, how much more, and how phased will it be? Some thoughts around that.
Yeah, hi, Gunjan. Harish here. On the cell side, you will see the segment assets in the regulatory reporting, so that's got covered there. Now, going ahead, which is a phase 1B, is under implementation, which will take us from 1.4 to 5 gigawatt of cumulative capacity. In that context, the amount that will get invested, already invested part of it from the term loan on that phase will get complete. So around another, we have invested almost 400 to 500 crores in that phase. The remaining money will get invested. And post that, for phase 2A, what we have raised in the IPO, which will take it from 5 to 6.4, so that the 1,200 odd crores which you have raised in the IPO will be invested in that. And that will obviously be leveraged for further project finance to take it to 10 and beyond.
Okay, got it. I'll join back the queue. Thank you so much.
Thank you. The next question is from the line of Rishi Vora from Kotak Securities. Please go ahead.
Hi team. Thank you for taking my question and congratulations on the IPO. Just first thing I wanted to understand, I don't know whether you shared it, I joined it a little late, but what would be the mix between premium and mass mass scooters during the current quarter as well as the last quarter, just directionally how it has moved?
Rishi, if you have the presentation that we've shared, you will see that in the automotive financials page, you will see the deliveries across premium and mass. So as you can see, premium is still fairly, so out of the 1.25 lakhs, 75,000 was premium and about 49,000 or 50,000 was mass. So premium is actually holding well and mass is continuing to grow. Last quarter, the premium was about 65,000. Mass was also 49,000. So while mass segment looks flat quarter on quarter, but I want to share with you that the deliveries in Q4, FY24, were from the order backlog of Q3, because Q3 is when we launched our mass product. So you should assume that on average half of that. So mass products have grown in terms of orders, etc. into Q1.
Understood. And how has been the acceptance of Ola S1X given the price point at which it is being launched? And given your mass market motorcycle launch in the coming quarters, how do you think the trajectory of electrification will happen within the motorcycle segment? Or do you think will it follow a similar trajectory as scooters, or will it be a faster adoption given the learning curve from the electrification in the scooter segment?
So this is the first part we had actually answered in my opening comments, but just to give you a headline, we've seen that mass market products have increased penetration and have largely not cannibalized our premium products. Obviously, there will be some internal cannibalization here and there, but premium has also incrementally grown and mass has added on top of it. So mass products are doing well in upcountry markets, even in urban areas, but it has helped us grow deeper into the country, the S1X product portfolio, 2 kWh, 3 kWh, 4 kWh. Now moving to motorbikes. Motorbikes are built on the same platform, so the cost structure is the same, and you can directionally expect similar pricing from us for a similar eventual margin that we see in the automotive segment today. We will have to obviously see how the market responds, but we feel confident that motorcycles will have, because it's 2/3 of the overall two-wheeler market in India, so it's a bigger market to tap into. And specifically, the mass market segment in motorbikes is also fairly utilitarian. People buy ICE motorbikes for their cost, not really for at that price point. And maybe at a higher price point, people might buy motorbikes for other brand reasons, but at the mass segment, people buy it largely for utility and cost. And that's where I believe the EV proposition of lower cost of ownership also will cut through. I think eventually we have to see how fast the market grows. But another good thing is now compared to 3 years ago when the EV scooters were just new, now the overall market of two-wheeler consideration customers is also being educated fairly well about electric. And as we bring in motorbikes, I believe that kind of education will help with a certain accelerated ramp.
Understood. And just last bit on the other expenses, just on a sequential basis, despite uptick in volumes, other expenses are down 12%. So, like, what has driven that decline? Any cost, like some cost, fixed cost has come down. Anything which you like to highlight?
So, I'm supposing you're referring to operating expenses in the consolidated financials. So that is, there is some level of just streamlining using technology that we have done on the distribution side. We've also cut down some inefficient stores, but we might be adding that back as we add more products out there. But largely, it's a continuation of this streamlining of operations using technology. That's the one main theme I would leave you with on operating expenses.
Understood. Thank you so much and all the best.
Thank you. The next question is from the line of Chandramouli Muthiah from Goldman Sachs. Please go ahead.
Hi, team. Can you hear me better this time?
So you
Hi, Chandra. Yes.
Hi. Good evening, and thank you for taking my questions, and congratulations on the IPO. My first question is just around your longer-term vision on where you see electric two-wheeler sales penetration in India over the next few years. And also related to that, what you think the industry...
Shall I answer that, Chandra?
Sure. Please go ahead.
Yeah. So, Chandra, I think that's an important question. Many people on this call might not have heard us in our roadshows, etc. So, actually, if you look at ICE versus EV, there are multiple opinions, and since it's a new domain for India, largely 3-year-old only, there's a very important, almost like a law of physics level of a fact, that ICE vehicles keep getting costly because of emissions compliance, and ICE fuel, which is petroleum or gasoline derivatives, also keep getting expensive due to macro factors. Whereas EVs will keep getting cheaper cost because of battery prices continuing to reduce through technology and supply chain innovations and scale. And electricity also, actually, our Prime Minister, Honorable Prime Minister, has a vision of making electricity free with his solar rooftop. So, while that's one scheme, generally electricity will be fairly available and affordable as we go ahead, right? So EVs are only going to get cheaper to buy and cheaper to use. Vis-a-vis ICE vehicles, they're only going to get costlier to buy and costlier to use. So this story only ends one way. Question is when and who will be the protagonist in this journey, and we hope we are well positioned to be that. But specifically within India, these are more just technological macro themes. But within India, the story for electrification, the main focus area is the two-wheeler ecosystem. Like that's where we started our journey from 3 years ago. And scooters is where we have a good portfolio now, and motorbikes is where we are putting our next sight on, and we'll see very good announcements tomorrow on that. So we believe, I wouldn't want to hazard a guess on timelines, but generally the penetration journey will continue with more products being announced. The cost of products continuing to come lower, and generally consumer confidence in this new technology increasing. And we are seeing that already anecdotally. There are people who are buying their second, third electric scooter with Ola. There are people who are, a lot of our, a reasonable amount of our sales come through customer referrals. So that word of mouth is strong. And as you guys know, we generally don't do much advertising. So a lot of our sales is actually just word of mouth and organic.
Got it. That's helpful. And just as a follow-up related to that, you have been a very fast growth company over the past 3 years. And as you project out where you think electric two-wheeler sales penetration can be, what are the sort of volume growth targets that you set for yourself? What are the sort of volume growth run rates you think the industry can do during the next 4 to 5 years when the industry has the tailwind of PLI subsidies?
If you look at penetration right now, scooters is about 20% in the previous month. And I believe that is now going to sustain and grow from here. As other competitors have also launched their sub 1 lakh rupee products, whether they make money or not on that is for them to figure. But as they launch, as we launch our products, as we also, tomorrow you'll see more products from us. With more products available for consumers, the consideration for EVs is only going up. And penetration overall 7.5%, scooters 20%. Maybe in 3-4 years this can be, in 25, 30, 35%. Again, I don't know. The market will play out, but that's the general direction. And the reason I feel confident of that is because two-wheelers in India are a mass Aam Aadmi product, and the lower cost of ownership is a very important proposition. And as consumers become comfortable with it, more and more people are adopting it. Now, our share in that, the market share is an outcome of multiple factors. Our focus is on obviously leading this journey as we have over the last 3 years. We want to focus on getting good products out in the market, being the leaders in getting good products out in the market, a vertically integrated manufacturing strategy so that we are able to make margins and price them well for consumers in an broadly accessible way. Competition might be, they might play pricing, they might want to play their margins. That's up to them. But we believe we have a very strong competitive advantage coming into this because of our tech, our vertically integrated manufacturing, and our existing strong leadership.
Got it. That's helpful. And lastly, just a question on other income for Harish. Just trying to understand, as part of the other income, if you could give us sort of a split between what is sort of PLI incentives in the other income you reported this quarter and what is sort of investment yields?
So if you look at the segment results, you find the other income. Actually, PLI is the account as part of the total revenue itself. So PLI is not part of other income. PLI is reported and accounted on the total income. Other income has got a set of ancillary income, service income, etc. But PLI as an accounting policy and acceptable policy for that is part of the total income itself, revenue itself.
Got it. So just as a follow-up, so within other income, is it largely investment yields or is there any other sort of operational items in there?
So other income would include all the ancillary income, service income, handling, etc. This will all be part of the various other components of the income. The treasury income, of course, will also be there, but that's obvious from the numbers you can figure out. But it's largely the ancillary related product income in that.
Got it. That's clear. Thank you very much and all the best.
Thank you. The next question is from the line of Kapil Singh from Nomura. Please go ahead.
Hi, good evening. Thank you for taking my question. Wanted to check on the gross margin improvement that we have seen. Could you elaborate a little bit more that what has caused this and are there more actions underway which could keep driving this, let's say between 4Q and 1Q? And is there any contribution differential between the subsidies that you got in 4Q and 1Q? If you could just call out that also, that what was the subsidy element in 4Q?
So let me answer the first part, Kapil. See, on gross margin, The main contribution between the last quarter, this quarter, which has been going on for the last 2-3 quarters, is the Gen 2 platform rollout. We started with the premium products late last calendar year, and then this calendar year, especially in this quarter, Q1 quarter, we have started rolling out the mass products, S1X Plus and S1X. So Gen 2, as you know, is a lower cost to manufacture platform, and that has helped us improve gross margins. There are some activities also which are supplier negotiations, better supplier management, as well as some contribution to because of the lithium prices being more stable. Now, looking ahead also, generally margins will be, like I said in my opening remarks, from here till about a year, we can assume incrementally improving. Some of that we might pass on as pricing tactically. That's a tactical call we take on a real-time basis or regional basis. But largely, the gross margins are a function of supply chain and the engineering from Gen 2 activities. Rishi, you want to answer the second part of the question?
So on the, so you can repeat the question, Kapil?
So I just wanted to check. We called out that there was about 8% PLI and 6% FAME, if I got that right, in 1Q. What were the comparable numbers in 4Q?
So if you look at the 4Q numbers, the PLI we had on 2 products. So our S1 Air got 35 for PLI in December.
I think 30 is broadly similar, right?
Yeah, 1-2% because FAME was higher.
Yeah, FAME would have been slightly higher.
Yeah.
And actually, net, the incentive of 13-14% combined would have come down in Q1 over Q4.
Yes. Yeah.
Got it. So Q1 incentive you are saying is lower than Q4?
Because FAME reduced in Q1 over Q4, right?
Understood. And just lastly, if you could also comment on, we are talking about the new cells which will start contributing from Q1 FY26. So what is the capacity of cells that we plan to start with? And which technology they will be based on? And in terms of EBIT margins also, will they lead to an improvement in EBIT margins once you start cell production? That's it from my side.
Sure. See, the cell production is starting Q1 FY26. The installed capacity right now is 1.4 gigawatt-hour. That is roughly equivalent, if you assume a 3 kilowatt-hour average in the vehicle, that's about 500,000 vehicles. So that's roughly our current volume today, give or take a little. So when we start integrating our cells into our vehicles, there will be a ramp-up period. Not all products will move on day one, but over a couple of quarters or so, the 4680 cells will be replacing the 2170 cells in all our existing S1 products. New products which start after the cell production will actually on day one start with the 4680 cell itself. In terms of cell chemistry, our cells, the 4680 is actually a platform which can support multiple chemistries. The first chemistry will be an NMC chemistry because that's what our scooters are based on. Eventually, in about, let's say, couple of years or so from now, we will come up in the same platform with an LFP and an LMFP chemistry also. And maybe sometime in the future, we'll publish a cell chemistry roadmap from our side. Today, we don't have it published. So we will be, this platform can actually support, and that means our whole manufacturing investments can support both type of chemistry, NMC and LFP, and their individual family derivatives like LMFP or LFP.
And on the EBIT margins also, if you can comment, will they also see an improvement as we start with our cells?
So let me just give you the headline on the cell. So on the financials of the cell, see, the cell costs are about 1/3 of the vehicle costs right now for us, roughly, rule of thumb. Now, as we look ahead into our own production, as we start producing it, we will be saving some of the margin that a global supplier like an LG or whatever global supplier would be making on that cell, as well as there's a cell import duty also, we will be saving that. So it will flow down into gross margins, and at a certain scale, it will flow down into EBIT margins also. That scale will be 0.4, but maybe slightly higher than that.
Thank you, and best wishes.
Thank you. The next question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Yeah, hi. Congratulations on great listing. One is on when we talk about premium products, we are just referring to their models, or it also includes some of the X.
Sir, sorry to interrupt, but the line is not clear. We're getting an echo from the management line.
Yeah, management line is not clear. You're right.
Sir, I think you can proceed, sir, with your question.
Okay. So, I think we just separate the mic and all of that from our system. Where is the mic? Just as far as you can. No, so I understood the question. I think the question is, what do we classify into premium and what product do we classify into mass?
Right.
So premium is Air and Pro, and mass is X, or all the variants of X and X+.
Got it. And when we are referring to PL incentive in one case, it would be only on Pro and Air, right? Not on the X series yet.
Yes. Yeah. And we've applied for the X series also for PLI incentives, and I think we're almost maybe this week or next week we will get it. All the certification and all is pretty much done. Yeah.
Got it. And we have talked about motorcycle launches, which we'll be talking about tomorrow. But how do we see our scooter portfolio? Are there any white spaces which are still there, which we are not yet catering? How do you think from that perspective?
Yes. So if you look at the scooter market, that's a good question. We have a portfolio in terms of price points from almost 75,000-80,000 to almost 1.4 lakhs, right? So we have a broad scooter offering. In terms of style, we have largely one style. There are some style white spaces like sports or bigger format scooters, touring scooters, etc. We have that in our mind, but nothing in the short term that we plan to launch. Our focus right now is motorbikes. But maybe in due course, we will make some announcements in that direction.
Got it. And lastly, can you talk about your net debt as of June and maybe currently post listing, post IPO proceeds?
So as on June, our total approximate gross debt would be around 2,800, and the gross cash in hand would be around $1,300.
So that is June, pre-IPO.
This is all pre-IPO. This is June 30th data.
Yeah, sorry, June you said 37 to 3,800, 3,700.
2,700 to 2,800 debt.
Okay, got it. Okay, great. That's all from my side. Thanks and all the best.
Thank you. The next question is from the line of Amin Pirani from JP Morgan. Please go ahead.
Hi, thanks for the opportunity and congratulations on the listing. I had a question on, the buyer of EVs, because you sold so many EVs. I don't know if you track this, but broadly, do you know as to, most of your buyers, are they first-time two-wheeler buyers or are they upgrading from a certain kind of product? Some insights there would be quite helpful.
Is that Amin?
Yes.
Amin, yeah. See, the buyer has obviously evolved from 3 years ago to now. 3 years ago, when the industry was, when we had just launched our first product, BS1 Pro Gen 1, the buyer was largely the early adopter, the slightly younger, urban, affluent buyer. Now, actually, because EV penetration in scooters is 20-odd%, our market share is fairly significant. We sell across the country. We have 700-800 stores across the country. So the buyer profile is now fairly diverse. The premium products like Pro, especially the Pro, which is a absolutely high-powered vehicle, higher than many 125cc motorbikes also in terms of power and torque. That buyer is a slightly more involved buyer who maybe an affluent student, college student, or maybe a first jobber, a little more urban focus on that product. As we have brought in S1X with the 4 kWh especially, we've seen a lot of delivery riders, etc., in urban centers start to buy it. Another interesting nuance is, when sometimes when the last I visited the stores, I saw a lot of women buying our scooters, with a very interesting insight that they actually find EVs much more convenient than petrol, because they don't have to go to petrol pumps to fill it. They can charge at home, and for women, these are interesting considerations in buying vehicles. So there are some buyers I've met, again anecdotally, that have moved from ICE premium bikes into EVs because they find those bikes bulky for cities, but they wanted a higher powered vehicle and they wanted an EV. So it's now a fairly broad spectrum and increasing penetration into upcountry markets also, as well as deepening penetration into urban centers like Bangalore, where it's it's going deeper than just the upwardly mobile buyer.
Okay, great. That's helpful. Second question is on your cell usage in your own vehicle. Sorry, I think there's an echo.
Sorry about that, guys. We will control.
Can I go ahead?
Yes, please.
Yeah. So you mentioned that from 1Q next year, we are going to have our own cells in our vehicle. Now, initially when you ramp up, should we be prepared for maybe a negative hit on gross margin and then an improvement? Because you are mentioning that as one of the areas which will lead you to a higher gross margin, maybe over a period of time. But in the initial quarter, should we be prepared for a negative hit when that happens?
I think on the gross margin level, firstly, actually, the reason we have shared segment with you also is so that you can appreciate the two business evolutions separately, as many of you have questions across individual segments. So the automotive, as I mentioned, will continue to incrementally improve without the cell also on gross margin through many, like I covered that. On the cell, at a gross margin level, I don't foresee a link to scale as much. With scale, we will improve gross margins, but the negotiated supplier BOM costs that we've gotten for our cell are fairly competitive, I would say, compared to the procurement of the full cell. There will be a different curve on the EBITDA, consolidated EBITDA margins, because the cell will take some kind of fixed costs and a minimum volume before the EBITDA margins start turning consolidated level better. But it will also be set off by the improvement in EBITDA margins on the automotive side through this period. So we are today not giving very clear timelines on when the consolidated EBITDA or profitability break-even happens, but actually gross margins should see continued improvement with the cell also. EBITDA margins, there might be a twin action. Automotive continues to improve. Cell might have EBITDA margins reaching to break-even at a slightly higher volume than 1.4 kWh.
Understood. And if I can just ask one last question, if I look at the segmental breakup, on the EBITDA level, there is a reasonably large unallocated part out of the overall EBITDA loss. So maybe Harish can help us understand what that unallocated is.
So let me actually take that, and Harish, you can add if I miss anything. So if you look at the unallocated, I think for Q1 it is 70 odd crores, 75 crores.
Yeah.
So of the overall revenue, it's about 4 odd %. So it's in, roughly when we analyze other companies who report segmental and their unallocated expenses to revenue, it's roughly the median range of cost to revenue. Now, obviously, we have an EBITDA loss, so as a ratio of loss, high. But largely, these are, if it's for 25 crores a month, these are largely corporate costs, corporate teams, finance team, etc., for the corporate office costs.
Okay. Understood. Thank you and all the best.
Thank you. The next question is from the line of Amit Hiranandani from Smiths Limited. Please go ahead.
Thanks, team, for the opportunity, and congratulations for showing good improvement in the operational performance. Sir, from here on, your first priority and focus will be to improve margins or to keep gaining market share. Also, sir, do you see more price cuts or price reduction post using your own manufactured cells?
So Amit, firstly, thank you for recognizing the improvement in margins. So you were the first one on the call, so we appreciate that. The team has worked hard to, and then, the whole team, not just Harish and I present here, but the whole team has been, along with on parallel the IPO, we've been hard at work to make sure we continue to grow as well as improve the bottom line. Now, looking ahead, our focus is to deliver profitable growth. In terms of pricing, we will keep tactically using pricing levers as long as our overall focus on improving profitability continues. Now, how that plays out in different markets, across different products, across different times of the year, some seasonal sales, etc. That, like I said, is a tactical decision for us. But the focus is to build margin or build supply chain strength through vertical integration, build technology in-house to bring margin in-house, and pass some of that to consumers while improving the general direction of gross margins. Now, with the cell, like I mentioned in my previous comments, the gross margin will improve. How much of that we pass on to consumers, we will take a tactical call at that time. But our focus remains on profitable growth and continue to focus on penetration with products as well as with the right pricing for the consumer.
Sure. This is very helpful. Sir, my second question is basically how much gross margin improvement one can expect once we use all our manufactured cells. And continuing with that, sir, on the cell manufacturing plant, how will be the arrangement between both the companies? At what margin sales will happen to Ola's two-wheeler?
See, the sale between the companies will be an arm's length transaction, although both are subsidiaries of the parent company itself. So at a control level, obviously, you'll see the overall benefit. But it will be at an arm's length. Whatever price you will be able to procure this cell externally from a vendor, we will price it like that. What was the first part of your question, Amit?
So, sir, how much gross margin improvement one can expect once we see all our manufactured cells?
See, on the gross margin improvement from our cell, if I just give you, I won't be sharing the specific maths today, but if I give you a way to think about it, the cell is, let's say, 30-35% of the overall vehicle cost. And globally, companies make about, let's say, companies like LG, CATL, etc., depending on the markets, but between 15-25% margins on the cell business. And this is on a global pricing. In India, the average pricing of these companies is slightly higher than the global averages, given the smaller scale of the Indian market. Now, you can assume, because we are manufacturing for now only for ourselves, we don't have a large corporate team in the cell business. So the margins that an external vendor makes, we will actually be able to save that at a gross margin level soon enough. And there's a 5% duty also that India charges, so that also will be saved. So you can assume that that's the rough way to think about it. 30-35% of the cost of the vehicle is the cell, and in the beginning there will be a certain gross margin saving, and as we increase our scale from 1.4 to 5, further our BOM cost will reduce due to higher volume, and you will improve your gross margin savings.
Yes, sir. The last one question, sir. Basically, we wanted to understand more on the your export strategy, the target markets, and what is your strategy for the growth over there. And secondly, lastly, bookkeeping is on the capex outlook, if you can give for the next 3 years. That's it. Thank you, sir.
On the export markets, India is actually a very strong exporter of two-wheelers to the world, and the ICE industry, and kudos to them, they've actually built a very strong global profile for Indian two-wheelers. In EVs, I actually believe India has an opportunity to become the largest e-two-wheeler producer in the world and the largest exporter of these across broadly the global south markets, be it ASEAN or Africa or Latin America or even parts of Europe. Our focus will be these markets. We're not entering any of these markets in the absolute near term, but it is on our medium to longer term roadmap.
And the capex outlook, sir?
On the capex outlook, primarily both the projects, both on the auto side and the cell side. Auto will consider the capacity expansion and augmentation at the right time and wait for the thresholds of our existing capacity. So that will be one one CapEx will occur. And the other is on the cell side. I think we discussed on the call that we are currently in the roadmap of going up to 5 and then 5 to 6.4 and then 6.4 to 10 and beyond. These are the broadly large areas where there will be CapEx, other than some sustained CapEx on existing processes, etc. These are the two areas where there would be investments in the next 2 to 3 years.
Okay, sir. All the best, sir. Thank you.
Thank you. The next question comes from the line of Pramod Amte from InCred Capital. Please go ahead.
Yeah, thanks for the opportunity. So the first question is with regard to the new cell which you plan to manufacture. It's interesting to see the high energy density which you are planning to pump in. But wanted to understand your thought, is it to reduce the range anxiety of the customer, or how are you looking at positioning this cell in your product line?
Pramod, the cell is the heart of the EV. Just like in the ICE vehicle, the engine was the heart of the vehicle, right? The cell is a constantly evolving technology, and that's why in the last 4 years we have invested a lot of time and energy, and my own personal bandwidth has gone into creating this cell technology in-house, and which you see in the 4680 cell that we've now made. The benefit of building this technology in-house is, many features or performance metrics of the vehicle are controlled by the cell. For example, the range that a certain cell capacity can offer, the amount of weight that your battery pack has, lower the better. That means the energy density of the cell matters. The charging time depends on the cell technology, not the charger. It depends on what kind of cell technology it is. And then the cost also, there's a lot of innovation in the chemistry that you can do to bring down cost of the cell. All of these we have, and also to make it more relevant from a thermodynamic perspective for the Indian market, the Indian environmental conditions. All of this we have done. So that's been our focus, and as we bring these into our product, it will definitely improve the product experience for consumers in terms of a lower weight, a product and higher range, slightly faster charging time, etc., etc. And with every subsequent generation of the cell in the next few years, each of these metrics will keep inching upwards.
Sure. And the second question is with regard to broadly, what's your thought process or expectation from the FAME policy? Since you have been a beneficiary of the same, and with that you have been now being able to put up a very strong foothold for the company. I'm asking you in the context that post the FAME subsidy is off in June, you have improved performance, and if I further dice it between premium and the mass, my sense is premium is already making a bit of break-even or profits. So how do you look at FAME incentive? Should it continue? What are the benefits you would still look at going forward?
Actually, that's a big point, Pramod. Again, kudos to you. You're the first person to highlight that. The premium products are obviously better compared to the mass products, fairly profitable. I wouldn't say profitable, I will correct my words. It is much better in terms of financial performance, and premium, the cost across the two products obviously is different. Battery sizes are different, electronics are different, but premium, we are able to price higher also and monetize them better. Profitable or not profitable, I don't want to comment on that today. I think that will be a little too much information for today. On the same point, the government has been fairly clear directionally that they will taper down the same subsidy over time. And already in 1.5 years or so, it has gone from 60,000 rupees a vehicle to 10,000 rupees a vehicle. So FAME is actually not that material in the larger scheme of things of the industry. I think the support is needed by the industry for another year or two, because 10,000 is still useful, about 7, 8, 10% of the overall vehicle value, still useful in terms of meeting the cap on profitability. But the industry is continuing to innovate, so we are continuing to innovate. So I think even if this level of FAME support continues, the industry will continue to grow well.
Sure, thanks. And the last question, if I can ask, looking at the two-wheeler industry profitability, which ranges from early part of double digit to some are in the higher double digit, and considering at one end you want to be profitable and the other end you are on a mission to drive EV penetration in the two-wheeler space, where is your ambition or a balanced profitability margin? How do you look at it? Or should we look at it more on ROC basis? How do you look at the business?
So if you look at our automotive segment EBITDA, and it's in the presentation that we also shared, you see, I'm just going to read out a few quarter numbers for you. Last 4 quarters, Q2 was negative 32%, Q3 was negative 10%, Q4 was negative 7.5%, and Q1, which is this quarter we're talking about, is negative 2%. So the automotive EBITDA margins have consistently improved for us in a period of reducing the FAME subsidy. And this has been driven by, like I said, the vertical manufacturing strategy of ours, vertically integrated manufacturing strategy, as well as the core technology development in-house of all EV-centric components. Now, these two themes will continue over the next couple of years. Long term, I believe EVs will be a very similar profitability number as ICE vehicles. Because like I said in the beginning, thematically, ICE vehicles are only getting costlier due to compliances, and EV vehicles are only getting cheaper due to the battery cost curves, the learning curves of the battery costs. So at what point that inflection happens, I'm sure all you analysts have your own models. I have my own. But in the next few years, not long far out, we will all be here, I believe, when it happens. Be here, and maybe we'll be doing a call together in the next few years, and that would have happened. Actually, already, if I just give you some macro commentary, in China, you're seeing that happen where EVs are now cheaper than ICE vehicles. Now, if China is there, the global supply chain for many of the input materials like lithium, etc., are common. As we scale up some of these manufacturing capabilities in India, and as we get some more scale of product volumes in India, I believe the same dynamic will come true in India.
Sure. Thank you, Radha.
Thank you. Ladies and gentlemen, we will take that as a last question for today. I would now like to hand the conference over to Mr. Abhishek Chauhan for closing comments. Over to you, sir.
Thank you so much. On behalf of Ola Electric, this concludes our conference today. Thank you so much for joining us, and you may now disconnect your lines. Thank you.
Thank you. On behalf of Ola Electric, that concludes this conference. Thank you everyone for joining us. You may now disconnect your lines.